Partnerships, Part 1, Termination, Predistribution Plans. Now a little summary, first of all, of the key issues associated with termination. Partnerships may be terminated for a variety of reasons. When terminated, partnership assets must be systematically liquidated. Actual liquidation can require an extended period to accomplish. This promotes the use of proposed schedules of liquidation. Marshaling of assets may be necessary when one or more parties have negative capital balances. And a reminder, a distribution cannot be made if a partner has a negative capital balance. When the partners wish to terminate the business, first they must convert all assets to cash. Allocate all gains or losses to the partner capital balances. Pay all liabilities, and then once that's done, they can distribute any remaining cash to the partners. Prior to making a cash distribution to the partners, assume, and this is if you want to do it before they've sold off the assets, you have to assume, to make cash distribution, all non-cash assets will be complete losses. All liabilities will be paid, and all deficit partners will be written off. That means a partner cannot have a negative balance. Even though assumptions 1 and 3 may be unrealistic, they allow the computation of safe balances, also known as a safe distribution. Schedule of liquidation. The process of liquidation can last over months, even years, most likely years. Partners may experience deficit balances during the liquidation process. Partners may want cash distributions prior to the completion of the liquidation. Accountants distribute statements at each important junction of the process. So now let's go through an example that'll show you what it looks like when they do a payout to partners when they haven't sold off all the assets, but there is some cash and the partners would like to know if they're going to get any money. Now here is our example. We have partners Pam, Bill, and Myra, and they share profits 40%, 30%, 30%. Here are the balances in the accounts. The partners decide to liquidate, and 50% of the assets are sold for $200,000. The cost to liquidate is $10,000. Prepare a pre-distribution schedule, also known as a schedule of liquidation, to determine the final payments to the partners. Now, first of all, before we can do anything, if you notice, we have a loan that Pam got, and it's on the books as an accounts receivable Pam, and we see that Myra also has loaned money to the partnership. So for Pam's $30,000 accounts receivable, money she owes the partnership, this is going to be converted to a draw. Now the $40,000 loan that's owed by the partnership to Myra is going to be converted to a capital contribution. So this is the journal entry that would be made to remove the accounts payable, Myra, and the accounts receivable, Pam, from the books. Now we can go through and do a schedule of liquidation. And remember, you cannot have negative balances in the capital accounts, i.e. they cannot be overdrawn. So what I like to do when I'm doing an example like this, the first thing I do is I list total assets, cash, liabilities, and then the partners, and then I always put their percentage ownership across the top, making sure that equals 100%. All right, now we have their beginning balances, but the first thing we need to do is we need to back out the loan, take the loan off the books, and the receivable off the books. So this is what we've done here, and now we have the partners' ending balances. Okay. Again, a partner loan payable is converted to a capital contribution and increases the capital account, and a partner's accounts receivable is converted to a draw. Now we have the balances that we're going to use to start the liquidation schedule. Now, the first thing we want to do is we need to write off the loss on the sale of the assets, because we got cash of $200,000. However, the assets were on the books for $410,000. So what we need to do is write off the loss based on profit sharing to the individual partners. The next thing that we have to do is write off the balance of the assets. So in the first case, we sold 410 of the assets for $200,000, and now we have the balance of 410 that we have to write off against the balance, the partners in the partnership. The last thing we need to do is we need to pay off the liabilities. Now these are the journal entries. Now we also have to make sure that we write off our liquidation expenses against the capital accounts. Now when we go through all of this, we're now going to see, is there any cash left over, and make sure we eliminate any negative balances in our capital accounts. So here we go. We show the sale of the assets and the write-off of the balance. And then we write off the balance. Since we had $820,000 in assets, we sold $410,000 for $200,000 in cash, but then we had to write off the balance before we can do a cash distribution. It's an assumption you have to make. We're trying to be very conservative. Then we're going to assume we paid off the liabilities and we paid off our liquidating expenses. And now we're going to see what are the balances in our capital accounts. In this example, nobody has a negative balance, which means they'd have a debit balance. So that means now we can do our journal entry, and we can at this time pay out $70,000 in cash. So now what does that look like as a journal entry? We would debit the capital accounts and then distribute the cash. And this would be the entry on the partnership books, and it would be our last entry if we assume that 410 assets we could get nothing for. And that excuse me. That concludes this presentation.